This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Professor Laurence Kotlikoff joining us this morning from Boston University. Professor Kotlikoff is the Williams Warren Fairfield Professor at BU as a professor of economics. He is Fellow of the American Academy of Arts and Science, a Research Associate of the National Bureau of Economic Research, and a former senior economist and on the President Reagan's Council of Economic Advisors. A long list and well recognized. Welcome, Professor Kotlikoff.
Thanks for having me, Gordon. It's nice to be with you.
It certainly is our pleasure. I recently interviewed David Stockman, by the way. Did you work together at all with him?
Yeah, but I did interact just in one meeting with. He was much more senior. He was the head of the OMB, and I was just a senior economist working at the Council of Economic Advisors. But I did have one meeting that I attended with him.
Well, he's very well. I don't know if you're following any of his work at Contra Corner, but he's very outspoken now on this situation and the seriousness of some of the problems facing America.
Yeah, we've met within the last about a year ago or so. We spent some time together at a conference talking about the situation, so we're definitely on the same page.
Today's discussion is part of our series on financial repression. And so I'd like to start it off, if I could. How would you explain to our listeners what financial repression is, or what it means to you, or the kinds of things you're seeing regarding it?
Well, I think the financial system needs to be understood as a public good, that it's a marketplace, and marketplaces are hard to organize and keep functioning. If you think about medieval trade fairs, they were marketplaces that were organized by the government, and you didn't want to have too many trade fairs happening at once because nobody would know which trade fair to go to. So getting people coordinated to trade with each other is kind of a public good. We don't have any auctioneers to, just clear markets with everybody at once. So we have a coordination issue. And the financial market is a marketplace like any other, and the banks are there to facilitate that market. So they're really controlling and operating a public good. That's what the banks are doing. That's what financial intermediaries are doing. They're basically making a market, and markets are public goods. And a good analogy here might be gas stations. We know that the highway system is a public good. It's helping us effect commerce, and the gas stations are facilitating the use of this public good. If the gas stations were all to gamble with their businesses, let's suppose that all the gas stations sold options to their customers that worked like this, that said that if the price of gasoline goes up, they won't have to pay more than $3 a gallon. And the gas stations today would be selling those things. And suppose the price of gasoline goes up to $10 a gallon. Well, all the gas stations in the country could go under, in which case we wouldn't have the ability to use this public good, the highway system, right? So we need to understand that that's the basic system. It's a public good, and the banks are here to help manage that public good. Now, the regulators are involved in trying to make sure that this public good continues to operate. That's why we have so much regulation of the banking system. It's not there by accident. We don't have 130 regulatory bodies in the U.S. to oversee the market for apples, right? We have only, we basically don't have a major regulatory structure for that. So let's just start there, that we need regulation because of the issue of keeping this public good working. Now, the question is what kind of regulation we need. Do we need to have so many regulatory bodies, none of whom can really ensure at this point that the banking system will keep functioning? We just went through a major financial crisis in 2008 where the banking system just nearly fell apart, and all those regulatory bodies didn't really save the day, and we had a huge recession. Now, we passed legislation called the Dodd-Frank law, which is adding more regulatory bodies and bureaucratic structures to the system. I think that the system is not safer. One part of Dodd-Frank is the limitation of the ability of the Treasury and the Fed to come in and rescue banks and keep the financial highway system operating. So in many ways, the system is actually in bigger danger today than it was back in 2008, because fundamentally the banks are still being able to operate with a lot of leverage, maybe a little bit less leverage, but still dramatically more leverage than really would be keep things safe. They're also being able to operate this public good with full opacity. They don't have to tell anybody what it is that they own in terms of assets or what they have as in terms of liabilities. So you have people who are giving money to banks in the form of demand deposits, checking accounts. They're giving money, they're getting back checking accounts, which are demand deposits. You can take back your money on demand. And they don't know for sure what the bank has. So when I say bank, I mean not just commercial banks, but investment banks and other shadow banks of all different types. So when you give your money over to these enterprises, these financial intermediaries, and you're told that you can get your money out if you're quick enough, and then you start suspecting some fraud, then you can easily have a run on the banks. And that's what we had in 2008. We had a massive run on the banking system. And the folks who initiated the banking run were actually the other banks. The banks were running on each other. That's really how things got kicked off when Lehman Brothers went under. All the banks stopped giving credit to each other. And that was really a run by the banks on the banks. So we're all set up to have this happen again. And the only real difference, because there's still lots of leverage and there's still all this opacity and there's still the possibility that people will get scared like they did back in 2008. They got scared because they realized that they didn't know too much about what companies like Lehman Brothers or Bear Stearns or Merrill Lynch had as assets. Nobody knew for sure, and so trust took a holiday. We have pretty much a faith-based banking system because we can't see exactly what the assets are of any of these financial institutions. They're not forced to disclose them. So that's opacity. Now, so I think the system is more fragile, and here's how I would fix it. I would fix it in a very simple way. I wrote a book called Jimmy Stewart is Dead, and it's about moving from the current faith-based banking system to a show-me banking system where we have financial intermediaries who have to disclose, actually with government's, the government's active participation, they disclose all the assets that they're holding. And instead of borrowing money to invest in assets we can't see, they would sell shares, do equity finance, take in money and invest in in assets that they then disclose. So what I'm talking about really are intermediaries that are mutual funds, that are equity finance mutual funds. And so the idea of limited purpose banking, which is this new banking system which I propose in this book, Jimmy Stewart is Dead, is, and the reason I use that title goes back to the movie It's a Wonderful Life, where we have Jimmy Stewart saving. Sorry. Sorry.
It's a great movie and really appreciating old style banking. Unfortunately, that's not the banking we have anything close to that today.
Right, and we can't rely on trustworthy bankers. We can't rely on faith-based banking. So the idea of this proposal, limited purpose banking, is that all the financial middlemen who are running this public good not be allowed to gamble with it. And the easy way to do that is to have them operate just as mutual funds that take in money 100% on an equity basis. They don't borrow anything. So if you don't borrow anything, you can't go bankrupt, right? You can't have the financial middleman go bankrupt. Just like the gas station can't go under if it's not allowed to gamble with its business. So you take in the money, you hand back shares, and then you invest the money in assets which are then disclosed. So think about a mortgage mutual fund. Well, Fidelity Investments is a mutual fund company, for example. There's also other ones, T. Rowe Price, T.I. Kraft. There's plenty of mutual fund companies. They already have mutual funds which invest in real estate and also in mortgages. So the way it works is these mutual funds will sell shares, take in the money, and then buy mortgages. There are mutual funds that sell shares, take in the money, and invest in stocks. Global, international stocks. There's some that invest in U.S. stocks, or some invest in developing country stocks. We have really thousands of mutual funds, something like 10,000 mutual funds in this country. Almost all of them are equity finance mutual funds. So we have about 30% of our financial system already pretty much in the form of limited purpose banking. That part of the financial system, mutual funds that are equity financed, did not fail during the financial crisis. There was no problem there. So the rest of the financial system collapsed. The leveraged financial system, part of the financial system, collapsed. The equity finance mutual funds did not. How are we rebuilding the financial system? We're resurrecting the leveraged part of it, and we're taking things that were built out of straw and reconstructing the financial system out of straw, not out of brick, which is what the equity finance mutual fund system really is. So what I'm proposing is that every single financial corporation be operated as a equity finance mutual fund. So the payment system would be based on cash mutual funds, where some of the mutual funds would be called cash mutual funds. They would sell the shares, take in the money, and invest it just in cash. And those cash mutual funds would be used for the payment system. So that's an old proposal. Just that aspect of limited purpose banking is called narrow banking, and that's an old proposal that was put forth in the 30s by Chicago economists, University of Chicago economists, and Milton Friedman supported that proposal. So you have cash mutual funds, you'd have mortgage mutual funds, so you wouldn't have Fannie and Freddie anymore. You'd have equity finance mutual funds. You'd have everybody doing their banking, in effect, through these mutual funds. Now, most workers in the U.S. are already in these mutual funds through their 401k plans.
Correct.
So for most of us, the financial system really is limited purpose banking. I want it to be 100%. I want to have the derivatives market not be this opaque $600 trillion behemoth, which can take down the financial system at any time, because the Federal Reserve and other financial regulatory bodies do not know who's got what outstanding CDS contracts that are fully, highly leveraged. Think about AIG. Why did they go under? Well, because they had these derivative contracts where they took in money they promised to insure things, and they took in the money and then they gambled with it. So it was not a safe way to run a derivatives market where they were insuring bonds of different types. Those contracts are called CDSs, credit default swaps. So here's the way I would run the derivatives market through an equity finance mutual fund system. It's the same way that we run bets at the racetrack. You go to the racetrack, some people bet on horse A, some bet on horse B. All the money is right there behind the window, and whoever wins, which, those who bet on horse A, if horse A wins, get the pot of money, less the fee that the racetrack charges, and they're the winners. Now think about the race, the horse A being Greek bonds default over the next 3 months, and horse B being that Greek bonds don't default. Well then, if all the money's on the table, then that's a safe way to run that derivatives market. That's a derivative because it's a bet based on something else. It's a bet derived from whether or not Greek bonds default. So it's a financial relationship or contract based on this other financial instrument. So that's why it's called a derivative. It's derived from. Okay, so that's a way to run a CDS market with absolutely no risk to the financial system because all the money's right there on the table. That's why I call that an equity finance mutual fund. And the bet could be, horse A could be that IBM shares go above this price by the end of the year. Then the market becomes a options market. So this mutual fund is running an options market on IBM shares. So you can run every type of derivative contract, whether it's options, swaptions, CDSs, whatever the bet wants to be, it can be run in a way that's safe for the entire financial marketplace for this public good. So that's what I'm saying. We have whether I would call the current system financial repression, I think the bureaucrats are having a field day. They've got this Dodd-Frank legislation, which allows them to set up more structures, more rules, but the system is not fundamentally safer. I think it's more dangerous. And what I'm proposing would have one federal agency, not 130 or whatever, federal and state. We just have one regulatory agency that would oversee the disclosure. And I call that the Federal Financial Authority. They would make sure that online you could check and see what your mutual fund was holding, and if it's a mortgage, you could go online and learn everything about that mortgage right in real time. So we would not have opacity and we wouldn't have leverage, and those are the two things that make the financial system extremely fragile and subject to ongoing failures.
I couldn't agree,
so that's,
I couldn't agree more with you in terms of the opacity, and some of us were screaming in 2004 through 2006 about the credit default swaps were exposed to collateral risk or contagion of counterparty risk because there was no money really being posted. And I'm trying to do research on the $700 trillion swaps marketplace through the Bank of International Settlement and really understanding what the collateral is that's being posted. It is completely and totally inaccessible to anybody except select international banks. Doing research on the $72 trillion shadow banking system and the elements of it, again, only consolidated through the Bank of International Settlement. This is massive when we consider that the global economy is barely $72 trillion itself, and that is highly leveraged with no regulations. It's not it's over the counter, completely totally transparent to nobody. So right. The risk has got, in my mind, much, much worse. And there is no regulation going on. And Dodd-Frank, frankly, my opinion, has been gutted since its original intent went into place. And we just saw this with the latest bill that went through that our friend David Stockman wrote about, and the magnitude of how flawed it was here in the recent fiscal policy that slipped in some changes in the Dodd-Frank. I need to shift gears so we don't run out of time here, if I could. Sure. Professor Kotlikoff, you've done some groundbreaking work in sizing the magnitude of debt, as big as the numbers were I just gave. you've shown that the real debt in the United States, when measured correctly, when looked at what the real liabilities and promises that have been paid to assess those, is north of $200 trillion. And I think to most people that just defies anything that they can imagine or have heard of when we think of the national debts being in the 16 to 18.5 trillion dollar. Can you help some non-believers with that?
Sure. Well,
tough thing to say and to do in a couple of minutes.
Yeah. Well, economics doesn't really distinguish obligations that are called one thing or another. If a government has an obligation to make a payment, it's a payment obligation. So whether the government has to pay interest and principal on treasury bills, or whether it has to pay benefits that are called Social Security benefits or Medicare benefits or Medicaid benefits, or engage in future defense expenditures, which we obviously have to do, all these payments by the government are obligations, and they all have a present value. So the projected path of these payments has a present value. So does the projected path of tax receipts. So economics says, let's look at all the projected expenditures, no matter what you call them, and let's look at all the tax receipts that are projected, with all their different names, and see whether in present value, the value in the present of all those projected expenditures exceeds the present value of all the receipts to pay for them. And if you do that, you form what's called the fiscal gap. So economists think that we should be measuring the fiscal gap, not one part of the fiscal gap, which is the official debt. The official debt in the U.S. right now in the hands of the public is $13 trillion. The fiscal gap is, based on the latest projections by the Congressional Budget Office, is $210 trillion. So $13 trillion is what we're focused on. The real number that we need to worry about is $210 trillion, because my 95-year-old mother is collecting Social Security benefits. That's a real obligation on the part of Uncle Sam. Actually, it's inflation-indexed obligation, whereas interest and principal she gets on Treasury bills is not inflation-indexed. But that aside, these are both obligations, and they're both going to have to be paid. Uncle Sam is not going to cut my mom's benefits, nor is it going to default on those payments on the Treasury bills. So we have to put everything on the same footing. That's the fiscal gap analysis. If you go to www.theinformact.org, theinformact.org, you'll see that over 1,200 economists, including 17 Nobel Prize winners, have endorsed a bill to mandate that the CBO and OMB, the Office of Management and Budget, and the GAO, the General Accountability Office, all do fiscal gap accounting. So the economists think as a group, and we're talking about the very top economists in the country, that we need to do fiscal gap accounting and look at the big picture, the whole picture, $210 trillion, and not at the $13 trillion bush in front of this big forest. Now, if you look at $210 trillion and you compare that to the present value of the GDP that the country is going to be producing, is projected to produce, we're talking about a shortfall of 10.5% of GDP every year. Mm-hmm. So we're short 10.5% of GDP to cover the government's bills. Now, to come up with 10.5% of GDP through time, we'd need to have almost a 60% hike in federal taxes. Every single federal tax, starting immediately, would have to produce revenue that's 60% higher. So we need a 60% federal tax hike, or we need to cut all benefits by about 35%, all spending, not just benefits, defense spending, paying for the president's lunch, Social Security benefit payments, all the expenditures would have to go down by about 35% immediately and permanently. So we have these two really impossible solutions. One is massive tax hikes, the other is massive spending cuts. Any combination is also going to be extremely difficult. So the country is actually broke, fiscally broke. The banks are holding a lot of U.S. government securities. Okay, they borrowed money. They said we'll repay it. They're holding securities, which they're holding this to some extent, this $13 trillion in debt, in government debt. Now, what happens when people start realizing that the government is printing money at the wazoo in order to pay for these bills? And these bills are coming due through time, and they're going to get worse. But the government has already on a course over the last 8 years of printing money like crazy. Last 7 years. So governments that can't pay their bills print money. And we're seeing this in the US, we're seeing this in Europe, we're seeing this in the Eurozone, we're seeing this in England. The Bank of England has been printing money like crazy, the Bank of Japan. So we can expect a massive inflation over time at some point. And that's going to make the value of these treasury bonds and bills go down. And that could put the banking system underwater right there. So we're seeing this today in Greece. Greece is, there's this interconnection, this nexus between the fiscal side and the financial side. And Greek banks right now are stuffed with Greek government bonds. The Greek government is about to default on these bonds. That's going to bring the Greek banking system, it's producing a run on the Greek banking system. And that could shut down the banks in Greece, close that financial highway. So there is this interconnection. The Inform Act would require us to do proper fiscal accounting and start fixing this problem.
You're not painting a very rosy picture here. Where does it end? Where is it leading? Because none of those are politically acceptable alternatives. I haven't seen the kind of leadership that even wants to talk about the problem. I have yet to hear anybody express as strongly as you have the degree of real obligations that are out there. So, and I'm not sure where Inform Act has went. I mean, I applaud it. But I don't. Right. What actions are being taken by our politicians? Any? What's your sense?
Well, I'm going to try and get the Inform Act passed, and with other economists, we're trying to push on that. And I'll be testifying to the Senate Budget Committee on the 25th of this month, and pushing the senators to pass that bill. So I think it will ultimately get passed. You can have the entire economics profession, with the exception of people like Paul Krugman who are extremists,
noted exceptions,
or Art Laffer. We've got people that believe in magic, economic magic, on the left and the right. We've got these demand-siders who are engaged in voodoo economics, and we got the supply-siders engaged in voodoo economics. But most economists, the vast majority, and the very top economists in the country, are endorsing the Inform Act, which doesn't talk about voodoo. It doesn't say that we can raise taxes by increasing spending, or raise taxes by cutting tax rates. No reasonable economist thinks that this is the way to eliminate a $210 trillion fiscal gap. And and we're seeing the government printing money. As I said, the Federal Reserve has increased the basic money supply by almost a factor of 5 since 2007, 4 or 5. We had about an $800 billion monetary base, which is the monetary base measures all the money that the Federal Reserve has printed over the years. So in 2007, we had an $800 billion monetary base. Today, it's close to $4 trillion. So,
but yes, exactly. And what they don't realize with this current policy is the unintended consequences that are accelerating significantly. We had Sweden go to negative interest rates here yesterday, day before. We've had Denmark come off the peg. We had the collapse of the Swiss peg. We're seeing negative real interest rates, of course, for some time, but negative nominal rates now. We're seeing it in bonds at BMW, Nestle's, etc. Negative bond rates. The ramifications of this in the financial market are significant. You end up with malinvestment, we're mispricing of risk, lack of price discovery. I'm out on the street, and to see what's going on, it's like does Washington even have a clue what they're doing? Well, because it can't keep going like this, and the speculators are running rampant because the way you leverage up is you leverage up and make money. Well, money's being made, but when the collateral starts to collapse, and it is, we're seeing bond shortages. It potentially could make 2008 just look like a minor warning. It's because the numbers are so large today.
Right.
So large.
Because interest rates have only one way to go, one direction, which is up. And that means that bond prices will go down. So that banks that borrow and make mortgages at low rates. And those, if interest rates go up, the value of those mortgages will go down dramatically. They'll fall like a rock. And same thing with corporate bonds, same thing with long-term government bonds. So the bank's holdings will drop dramatically, and then they're going to be bankrupt. And we can then have a run again on the banking system and have even more money printed by the Fed. So this is not...
Are our politicians truly cognizant of what's going on? In your sense, in talking to them, do they really appreciate educated enough, or do they believe the problem is so significant that the only way out of it is to wait for the crisis?
I don't think our politicians understand the magnitude of our fiscal problem. If they did, they would probably be have been looking at the fiscal gap for years now, not finally have a bill that a handful so far of senators and congressmen have endorsed. So I think they've conveniently put blinders on in terms of just trying to measure one liability and ignoring all the others. I don't think they have really understood how much money the Federal Reserve has been printing and its implications for that. If Milton Friedman were alive today, he would be screaming out loud about this.
I can tell you right now, there isn't a trader in the world that isn't fully cognizant of the rate of the growth of the balance sheet and how closely correlated it is to equity markets and all other kinds of instruments, and are playing that arbitrage every single day.
Yeah.
Which makes it worse and worse. But everybody's ready to run for the exits.
Well, so, we don't have, in our country, we have a government with essentially no economists in Congress. I don't know if there's any PhD economists that are in Congress, in the Senate, in the House, not a single one. So how would these people be expected to understand exactly what's going on? And then you have them being forced to listen to people like Paul Krugman on one side and Art Laffer and others. So you got the ones that, you've got people that are believing in black magic on both, or voodoo economics. So it's a difficult
I just did an interview with Professor Steve Keen in London, and who had just moved from Australia, full professor, and he said that if you aren't a mainstream economist, that is a strong believer in Keynesian, you will not be at an elite university. You'll be at a second tier, and those of things like the Austrian school, etc., or speak out. He says you very much limit your career in economics, and he's quite strong and he's well written. Is he even close to being right in that comment?
I don't think so. I don't really, in the U.S. case, I don't think that's the case. I think we have a pretty heterogeneous set of views about. There is kind of a mainstream view, and I don't think it's Keynesian, extreme Keynesian. I don't think it's supply side economics. I think there's some basic understanding of budget constraints that countries can't spend more than they produce, and our country. The counterpart of the government spending, having a huge fiscal gap, is it's letting people consume more than the country can afford.
Is that really the issue?
If you look at our
more than we can produce, and we do not have sound money.
And if you look at our national saving rate, which is a very good indicator of this situation, the national saving rate out of net national income was 15% in 1950. It's now about 2%. So over time, the national saving rate has headed downhill over the last 60 years. It's gone, it's fluctuated, but it's been a basic trend downward. And if you look at who's consumption,
as is the real rate of disposable income also.
Well, the ramifications, if you don't save, you don't invest. So the investment rate was 15%. It's now down to about 4% of national income. So think about all that investment that we'd otherwise have done in the country over all the years, had we been still at 15% in terms of our net domestic investment rate. It's going downhill, so therefore our workers have less capital, less equipment and plant to work with, and less infrastructure, because that's also part of investment. Our road system is, if you look at Boston, we have a subway system that's not operating. We've had,
We
one.
have one snowstorm and we shut down the transit system
Yeah, and then
completely.
nobody can get to work. I mean, it's just a complete mess.
So we're not investing in infrastructure.
Yeah,
And,
we have
and
no subway cars that are modern. So,
And to support your point in the magnitude of what I said earlier, the malinvestment, the issues that are associated with this. Last quarter, the S&P 500, 90% of all profits were returned as buybacks to drive up earnings per share and reduce the dividends and pay out the dividend. None of that, the other 10%, potentially could go to capital investment. We've been doing that consistently here for 2 years to the tune of close to $2 trillion in stock buybacks, which drives stocks up. That's no capital growth, and we're watching revenues, that is the top line, plummeting. So we're not investing. And it's a developed world problem. This is not just the United States, because there's no incentive to really invest.
yeah.
And that's
So we have a lot of,
what I'm seeing.
we have a lot of challenges.
But
There are,
but they are fixable. But you can't fix them unless you know the problem, right? Or talk about the problem.
right.
And that's what I really applaud with yourself, to take this forward and to fight and get it in front of the government, because I'm with you. I don't believe there's some evil strategy going on. I think these are good people generally wanting to do the right thing. But frankly, we have the Keystone Cops. It's a lack of education and fully understand, and really getting out and understanding, because if they could follow some of us around on a daily basis, they'd go back to Washington sweating. But I don't think they spend any time on trading desks.
Right. Well, okay. I think economics does have something to offer here. The Inform Act is a bill that economists have endorsed.
But I sorry to interrupt. But that was brought forward. I mean, I was reading about it in the fall of 2013, and I applauded it. And I know that you're pushing as hard. Why is it taking so long to even get it tabled in Washington?
Politicians don't want to acknowledge the truth about what they've been doing. And they've been spending, both parties have been spending 60 years basically immiserating our children, because they have left our kids with these massive bills. And if you look at I said that national consumption is way up as a share of national income. The people who've been consuming so much more are the elderly. So we've been engaged in a massive redistribution from young people are being left with these big bills to current, recent elderly and current elderly. And the age consumption profile used to look like this, so that older people were consuming less than younger people, middle-aged people at least. Today, the age consumption profile is a straight upward sloping line, so that older people are consuming a lot more relative to younger people, middle-aged people, than used to be the case. So that's exactly what
the younger
policies.
people today are so burdened with student loans, living at home with their parents,
Right.
can't get out, can't possibly dream of a mortgage that
Right.
people would assume at 20s. Now in their 30s, they're not even thinking that way anymore. They're not as portable, better educated, and don't see any job opportunities that really pay a decent salary, unless they're going to be working in a donut shop, et cetera, et cetera. And I'm not there's a lack of real earnings wage out there to support a family today. So
there's a lot of challenges. Education system is not what it should be. There's a lot of competition with foreign workers. The robots are coming on, take people's jobs in all kinds of fields, and a lot of the growth in employment in recent years has been in the energy sector, and now that's heading south. So the country's
based on leveraged junk bond offerings.
Yeah. Well, the country has a lot of problems, independent of the way the government's operating things, and the government's and the banking system. So we can at least go and try and fix the banking system with limited purpose banking. We can start honestly portraying our fiscal liabilities through fiscal gap accounting. That's the Inform Act.
Precisely.
If you go to the purpleplans.org, thepurpleplans.org, you'll see some proposals that I put together with after a lot of discussion with economists about how to fix the healthcare system for good and for real, how to fix the Social Security system for good and for real, how to fix the tax system for good and for real, and how to fix the climate change we're facing for good and for real. So we do have ways forward, at least to deal with the things that policy can deal with, but we have to get going. And
Exactly. We have to wrap now. Great discussion, and I know in my world, a lot of people have a lot of respect for the work that you're doing and speaking out, and I applaud you, and I just hope you just keep doing it. Any key messages you'd like to leave for our listeners?
well, help us get the Inform Act passed. Talk to your members of Congress, senators and congressmen, and ask them to endorse the Inform Act and get it passed this year.
I think that's a great action. And I think that I say to all of our listeners, here's somebody trying to make a difference, doing the right things. Give them your support. I've got to have you back in the future. We've got a blizzard coming in here this weekend. I hope that you're going to be all right up. And we'll talk to you again later on in the year.
Okay, my pleasure.
Thank you. Thank you very much.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.